I think the Fed actually cut rates, as we said, when CPI falls below Fed funds, because then they can turn around and say, see, I've done it, because there's a lot of 1970s Volcker fans who say, well, you don't defeat inflation unless Fed funds is above the inflation rate. So I think they'll probably do that. And then Powell can have his book written about him, how he beat COVID and then beat inflation. And isn't he amazing, right? Inflation was actually probably beaten by the economy itself. But, and the 2-year rate, that did enough damage for everybody. But that's how I think about it. The wild card for the inflation expectation story is not actually the expectation, because expectations are made pretty anchored. It's actually this dynamic that Andreas has talked about a reasonable amount as well, and we're all observing, which is, the oil market is tight. Some of the commodity markets are tight. If you bring back growth too fast, then does that create sticky inflation? I go back and look at the 1940s and early 50s, that period from 1946 to, let's say, 1952, where we had identical situation. Everybody come back into the labour force. The factories had to retool and come back to work. Inflation exploded, obviously. It was at 20%. It went down to -2 or whatever it was. Mathematical rate of change and a slowdown in the economy can do that. And I kind of expect inflation to go negative this time around as well. But then the rebound effects, because you still haven't cleared through all of the structural issues, inflation went back up to about 6% and then eventually settles down after another recession or tightening cycle. That tightening cycle back then was yield curve control as well. So they didn't allow it to go as mad because they realized the damage they would do to the economy. So I kind of feel like we're potentially into a similar situation.
Since March 2022, traders and so-called analysts have been forecasting a policy change or pivot from the United States Federal Reserve. Apparently, such a move would prove that the Fed's only available option is to print into oblivion, further diminishing the value of the dollar and enshrining Bitcoin as the world's future reserve asset and ultimate store of value. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul shares his outlook on the current macroeconomic scenario, including the Fed's most recent rate hikes and its overall impact on the market. Raoul also updates on the inflation picture and recession fears.
Yeah, and I think the market's obsessed by this topic. And look, I don't think it's invalid, and it's something I would take seriously in consideration. So one thing, let's talk about the buybacks quickly. What is clever about the buyback strategy, or some change in the Basel III that allows money to get out of the reverse repo, because it's trillions are trapped there, is you can keep raising rates, but you're actually adding some liquidity back into the system. It's a bit of an optical trick, right? But it actually works. So that's interesting. So the Fed can keep credibility while the Treasury are bailing out the economy. Okay, same with the fiscal side. That's what we're seeing in Europe. It's not so easy on the fiscal side. If you go too big, you punish your currency. So, okay, there's a bit of that.
Well, on November 2nd, the Fed raised interest rates by the expected 0.75%, and equities and crypto rallied like they usually do. But this time, there was a twist. Prior to the Federal Open Market Committee meeting, there were a few unconfirmed leaks stating that Fed and White House were considering a policy pivot. According to comments issued by the FOMC and during Jerome Powell's presser, Powell emphasized that the Fed is aware of and monitoring how policy is impacting markets and that the latency of interest rate hikes is being acknowledged and considered. The Fed stated, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags in which monetary policy affects economic activity, inflation, and economic and financial developments. Sounds a bit pivoty, no? The crypto market seemed to think not, and shortly after Powell gave his live comments, Bitcoin, altcoins, and equities retracted their brief single-digit gains.
There's two big things, I think, is when we step back. People hear me talk a lot about debt, demographics, all of these things, but what it is, and I kind of distilled my thinking down, is what is GDP? GDP, essentially GDP growth over time, not quarter by quarter, is driven by demographics, i.e. population growth, plus productivity. That's the kind of magic formula. Once you understand that, you can build a framework around it. And the framework of understanding is, as I've been talking about, demographics as a net draw. And I know there's some arguments out there from others that maybe the capital gets released by the baby boomers and it could be inflationary. There's no evidence of that anywhere in the world yet. So, that's a risk to the view, and that's fine. So demographics is a real problem for the Western world plus China, plus Southeast Asia. Aging populations mean GDP growth goes down. What we've seen is because of globalization, technology, and too many people in the workforce at the same age, the baby boomers, they've competed for wages, and real wage growth has been flat for 40 years. So i.e. the average American has had zero increase in wages. And the second drive why that's occurring is obviously the competition at wage level, i.e. 76 million boomers competing with each other and now competing with their kids. They're both in the labour force at the same time, competing with AI, robots, the internet and everything else, competing with Chinese workers and Indian workers. I mean, that's a pretty difficult environment for everybody. Nobody really wants to increase immigration. So Alf, you're in Italy. Italy had a huge immigration and everybody wants to slow it down because it's hard to digest at societal level. The UK had the same, Germany's had the same, Denmark's had the same, Sweden's had the same, everyone's had the same. So population immigration, not that these populations are particularly against immigration, but there's a limit to the number of people you can accept at any one time without society breaking, because what happens is there's too much competition for jobs again. So you lower the real wages of the population. So then let's focus on productivity. Productivity has been falling for about 40 years as well, which is kind of weird because we've had a lot of technology, but productivity keeps falling. So GDP growth has been falling over time. And what has happened is everybody's taken on debt to offset it, whether it's governments or whether it's individuals or corporations. So everyone's been taking on debt, which offsets the decline in GDP. Problem is each dollar of debt is driving less GDP each time. So it takes, I think, $1 of debt to drive $3 of debt to drive 1 unit of GDP right now. So it's been falling over time. So how the fuck do you solve a problem like this? It's a real issue. Now, the issue is the debt part of the burden is something that is potentially solvable. So how do you reduce that debt burden to free up capital and, velocity and all of the things that you kind of need to get the economy driving? And to free that up, you're going to have to either pay back the debt, which is never going to happen. You have to inflate it away with headline inflation, which is happening now, which is too societally painful. So the central bank quashes it immediately. Or 3, you have to run negative real rates for extended periods of time, much like the 1950s.
The shock here is not that Bitcoin's price pulled back prior to the FOMC meeting, rallied after the estimated hike was announced, and then retracted before the stock market closed. This is to be expected, and I wouldn't be surprised if BTC returns to the lower end of $21,000, since $20,000 appears to be solidified as support. What is surprising is there was a dash of pivot language, and markets didn't react accordingly. Let that be a lesson on buying into narratives too deeply.
And those are the issues we've seen in Europe as well. Some of the countries where economies are growing really slow and debt's been growing faster. Italy's a great example. It becomes unmanageable. So that kind of issue is why we get fiscal stimulus and monetary stimulus, always. So there is an endless need for the cowbell. The cowbell of stimulus has to come because it doesn't function without it, because we don't have population growth and we don't have productivity growth. So if you're looking at the really big picture here, the cowbell comes every time GDP growth goes down for an extended period of time. Nobody can allow asset prices to fall for an extended period of time because they are the collateral of the system. So at any one stage, we can see, we're already hearing it in the US, right? The Treasury buybacks, right? That's actually some form of net stimulus. It's not quantitative easing, but what it's going to do is probably push money out of the reverse repo markets, back into the bond markets. That's a net liquidity push. That'll filter through into the economy. We're seeing the fiscal stimulus both in Europe and the US. We've seen it in Japan as well, which is transfer payments, which is something I've talked about for a long time, is something that people are experimenting with as a new way.
So, do you agree with Raoul Pal's warning about rising inflation and rate hikes? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.